Finance matters for wealth. Anyone who's got any doubt about that proposition just has to look around this building. And it's only economists who could really have suggested that it might be otherwise, because indeed, for a long period of time, there was a view that finance is the handmaiden of industry, not vice versa. I think many CEOs of corporations would have doubts about that proposition now. But even they have now begun to be convinced because of the correlations and indeed the causation between finance and wealth. But it's not just in relation to wealth that it matters. There's now a great deal of evidence that it matters for growth, development, and the absence of wealth, inequality and poverty. And I'll be saying a little bit about that a bit later on. And it seems to matter most because it affects the development of industry and new enterprise, as well as the interests of individuals and consumers. And it does so through financing, in particular firms that have external financing requirements, and providing oversight and governance of them, as well as funding. But we're about to screw up that relationship because we're interfering and managing it in an entirely inappropriate way. And one of the reasons that we're screwing it up is that we're failing to recognize the way in which finance is evolving. We've traditionally associated predominantly with banks. But of course, over the last 30 or 40 years, banks, in some instances, have become essentially obsolete as markets have begun to substitute for them. And then as markets and securitization and things like that have substituted for them, lo and behold, new forms of financial intermediaries emerge that originate, aggregate, evaluate, and disseminate finance and information. And in that process, the nature of the response that we need to make to the financial system changes fundamentally, but it isn't. And it isn't because the way in which we regulate and the laws we have are in large part dictated by what was put in place decades, almost centuries ago. Now, what's making this particularly significant now is the congruence of that development with the emergence of fintech, of the technological developments that are taking place in finance, which are transforming them in forms that we're all familiar with, like crowdsourcing, peer-to-peer lending, the emergence of Bitcoin, program trading, which has been around for ages, the automation of credit scorings, and things like that. And one of the most dramatic instances of it is, I think, this. Not in the skyscrapers of London or New York, but in the slums of Nairobi and the rural areas of Nairobi. This is a kiosk that's associated with the emergence of mobile money, by which people come to these kiosks, they hand over cash, they get credits put onto their mobile phones, and then they make payments and do a whole series of things with those credits on phones. And its growth has been simply dramatic. What this shows is that over a period of 3 years, the penetration of mobile money in Kenya has extended to 70% of the population. It took mobile phones in Kenya some 6 or 7 years to reach that level. It took mobile phones in the United States 20 years to reach that level. So the rate of penetration of this in Kenya has been extraordinary, but it's not only that, its impact in terms of what one might term financial inclusion, that is to say, access to formal financial arrangements has expanded in Kenya from a quarter of the population to 3/4 of the population in a period of 10 years. And that's associated not only with a massive increase in the number of people who've been associated with it, from 5 million to some 29 million people, but also with a growth in the value and the profitability of this business. Okay, so financial inclusion in the form of Safaricom has also shifted from being a revenue generator of 166 billion Kenyan shilling to some 3 trillion Kenyan shillings over that period. Now, what's key to this are 4 things. The first is the exchange, what goes on at those kiosks. You hand over money and you get credits on your phone. The second is storage. It's a form of storage of money. The third is the obvious thing that's associated with a mobile phone. It's transmission. It's transmitting those credits to other people and thereby making payments. And what's key to the success of this are probably 4 things. The first are those agents situated all over Kenya where you exchange your money for the credits. The second is the security of the storage, the custodianship of it. The third is the functioning of the telecoms. And the fourth is to recognize that this is not banking. This is payments. And although we tend to regard payments as being associated with banking, the one major insight of mobile money is we shouldn't be doing that. Because if we do, we misregulate it and we undermine it. And indeed, that is exactly what's been happening in many countries around the world. It's the reason why it's been expanding so rapidly in Kenya, because it has not been treated as banking, and it's failed to emerge in India until recently because it's been regulated by the Reserve Bank of India as banking. And this demonstrates how Kenya has now reached the point where its level of financial inclusion is about the highest level of any African country, almost equaling that of South Africa. Now, this point about understanding what different parts of the financial system are doing does not just apply to payments and to mobile money, it applies to many areas. Another area that I talked about in relation to disintermediation has been the allocation of funding, asset management. Now, key to understanding the way in which asset management should be regulated is to appreciate the different forms in which it emerges. In some cases, it's essentially standalone businesses, and the article describes how these features vary dramatically across countries in terms of the nature of the asset management business. In some cases, it's essentially a pass-through business. It's not actually money that comes from the institution itself, it's just passing through the money provided by clients. In some cases, the businesses are unlevered, in others they are levered. In some cases, they provide guarantees to their investors, in others they don't. In some cases, they are servicing individual investors, and in other cases, institutional investors. Now, understanding those characteristics are then critical to appreciating how one should be responding to the new developments that are taking place in financial markets. If one regards peer-to-peer lending as equivalent to banking, then one will regulate it as banks. But if one regards it as being distinctive, then one should not regulate it as banks. And again, key to understanding the nature of the regulatory response to this is to go through this list of issues. Is the particular form of peer-to-peer lending essentially a standalone business that is not interconnected with others? Is it a pass-through business? Is it leverage? Does it offer guarantees? Are its investors predominantly institutional? Are they sophisticated investors if they're individual investors, or unsophisticated investors? And if one concludes that it's essentially pass-through, which is unlevered, which doesn't offer guarantees, it's a relatively low-risk business. If it's standalone, and has individual as against institutional investors, then the degree of systemic risk associated with it is modest. It's predominantly idiosyncratic risk business. If the investors are sophisticated, then one might think that caveat emptor should apply rather than seeking to have extensive investor protection. Now, this notion that one needs to tailor regulation to the nature of activities that financial institutions are engaged in is critical to getting the response to what's going on in financial markets right. Because if one doesn't, then one encourages precisely the types of arbitrage that one observed in relation to the emergence of the shadow banking system occurring, when people set up institutions that are not formally classified as being something and therefore regulated in one particular way, but essentially do exactly equivalent things. In other words, one encourages regulatory arbitrage, which then gives rise to the risks of failures of the sort that we observed during the financial crisis. So regulation is key, and getting it right is key in terms of not killing off fintech and desirable technological innovations, and it's also key in not encouraging innovations that are essentially just regulatory arbitrage that are undesirable. And what one needs in terms of designing regulation is then to think about function, not form. The way in which we structure regulation at the moment is in terms of institutional form. Is it a bank? Is it an asset management company? Etc. We need to think about the functions in a specific, not a generic way, along the lines of what I was just suggesting, and we need to be forward-looking rather than the retrospective approach that is currently taking in terms of catch-up of regulation to what the financial system and institutions were doing in the past. And in particular, we should focus on those risks that threaten not individual institutions that are idiosyncratic in nature, but are predominantly systemic. So what this suggests is that technology is opening up fantastic opportunities. But there are also fantastic risks associated with it that might make it unsustainable if we don't respond to it in the appropriate fashion. And responding it in the appropriate fashion means regulating in terms of what that innovation is doing, not in terms of its institutional form, and thinking about systemic consequences rather than individual institutional consequences. Now, this point, although I've discussed it in relation to financial systems, is a general point. It's about the way in which regulation can encourage wealth creation, but can also promote wealth diversion. Wealth diversion is simply the transfer of wealth from one party to another, and that is essentially what goes on when regulatory arbitrage takes place. It's the product of having differential regulation when one needs to have equivalent regulation. And it's expensive in terms of not only giving rise to that diversion, but also, as we know goes on in the financial systems as a whole, allocation of resources to activities which are not overall productive in terms of enhancing total wealth. In essence, technological innovation can give rise to both creative destruction, but also, if the response is inappropriate, it can destruct creation. And the reason why it's quite capable of doing that is it in essence makes this problem about equivalence worse, because one has modern forms of technology, what one might regard as modern equivalent assets, for doing things in a similar way to the ways in which they were being done in the past, but which need a very different regulatory response. And to give you another illustration, if you think about this in terms of the sharing economy, the emergence of Uber can be viewed as essentially a form of taxi provision and regulated as a taxi. And if one does it in that way, then, as for example the French are trying to do, you essentially kill it off. But not only do you kill off an industry that's potentially of considerable economic efficiency enhancing and wealth enhancing, but you also fail to address the issues that are really critical to that type of industry. Because it's not essentially about a monopoly provider. On the contrary, it's about undermining an existing monopoly provider. What is much more significant in terms of the innovation in that particular industry is the significance of trust and how the different parties set up relations of trust with each other in terms of the customer trusting the taxi provider and the taxi provider trusting those who get into their cars. But the reason why, although this is a generic issue that relates to all manners of newly emerging industries, it's particularly of importance in finance is because finance is a particularly complex industry. It's a particularly opaque one in many respects in terms of really understanding what's going on, because of its level of connectivity, which creates much more of a systemic risk than exists in many other industries, and because of its centrality in all of the activities that go on in our economies and in terms of wealth creation. So while financial systems and institutions are particularly critical to wealth creation, they're also subject to particular fragility. Thank you.
Most appreciative response, I thought. Michael.
My main comment is I agree with Colin, so thank you very much. That was the short version of the comments. So, okay. The slightly longer version of the comments is, yes, the way to think about this phenomenon is one needs to look at transactions of various types of services that are being provided and unbundle them conceptually in all their component and constituent parts, and then think about each element and provide functional regulation for that element. So just to spin out a little bit, in the world of mobile money, a lot of people talk about two types of business models: bank-based mobile money and mobile network operator-based mobile money. I think just starting off the discussion like that is already putting it on the wrong track. You need to think about what exactly the functions are that are being performed, like the ones that Colin laid out. Is it exchange that's taking place? Is it a storage function that's taking place, etc.? Decompose ex ante and then regulate according to those functions. The challenge will be to have a really good unbundling discussion up front, both for business model purposes as well as for regulatory purposes. So that's the general point here. And as last night we talked a little bit about comments, etc., and I said I would like to mention that the similar things applying to Uber, Airbnb, etc. So you have already made those points. I'm not going to repeat it. So just a few last comments on the link to wealth. So on the one hand, more functional regulation would hopefully lead to greater wealth creation or enable business models that lead to greater wealth creation. So that's one point. The other thing is the measurement of value added coming from financial services in this particular case. And calculating the value added of financial services is a tricky business, in the national accounts to figure out what is an actual service being provided and what just reflects excessive risk-taking is fundamentally the issue. And if you get regulation right along the lines that Colin proposes, then somebody is making the judgment, supposing this works, then somebody would be making the judgment whether that the things that are done are value adding. and therefore the spreads that are being used to characterize what is the value added in the national accounts would be accurate measures of that. So somebody has to make that judgment, whether it is excessive risk-taking or not. And if it's delegated to the regulators through a sensible system of functional regulation, then that takes away some work from the accountants. Thank you very much.
Thank you. And again, we have the luxury of a bit of time for some questions from the floor. Diane.
Thank you, Colin and Michael. It's really interesting. But I think it's not just about regulation. It's a harder problem than that. To take the Uber example, there's quite a lot of evidence that Ubers will go into areas of cities that not only conventional taxis won't go into, but the public transport's very poor as well. In effect, it's becoming a public transport network for some poor areas. So if you think about the challenge of capturing the social value that's being created by these new technologies, the pure efficiencies, the matching gains, and so on, you could think about delivering all kinds of public services using them. Uber could do public transport really well. Platforms could do Meals on Wheels or other kinds of social services very well. But the politics of switching from the model we have now of who creates the value and how that value is distributed to a world where there's this whole new social value potential out there and organising the distribution of those gains, I think is a political problem, not just a regulatory one.
Yeah, if I could I answer?
Well, I probably could collect one more, if that's okay. We'll collect at least one more question. Willem?
Just a small point that Uber is a wonderful thing and I use it all the time. Part of its comparative advantage is another form of arbitrage, right? That it's, especially in the US, where it's the people that work for it are not counted as employees, therefore not entitled to benefits, but as self-employed subcontractors. And that gives them an enormous competitive advantage because of this legal definition. So again, it's a form of arbitrage as well as technological superiority.
I have Cameron, then Ed. Cameron?
And just a quick one. My apologies if this was discussed while I was frustratingly had to be out of the room. But Adair Turner famously said that a lot of finance is socially useless, and yet it does feature in the national accounts in a fairly big way. How do we capture effectively, and I know you're talking about the regulation bit, but just think about the wealth measurement side. How do we accurately capture what finance is contributing to national wealth?
I have a question. Ed, sorry, and then Michael.
Thank you. I was thinking maybe this is a little bit of a tangent and not quite not quite germane to your talk, but I was thinking about payday loans in the United States, which appears to have some of the same characteristics as these new financial systems that you were talking about. And I guess probably, as most people are aware, it's led to a lot of financial difficulties for poor people. So, you know, the tone of your talk was, we don't want to regulate these new industries. Not that you said that directly, but it was sort of implicit. But at least for payday loans in the United States, has been kind of a disaster for many poor people. So I think you might want to keep that in mind.
I wonder, I might turn to Colin now, if that's okay, Michael, just to give you adequate time.
Thank you for those comments. First of all, your point about these new forms becoming essentially providers of public services. I think that is an extremely interesting and important area, and I think that is something that can have potentially substantial benefits associated with it, insofar as one is opening up the potential for much wider providers of such public services and to extend the example of Uber, what is likely to be even more significant than Uber is the emergence of driverless cars, when basically people will be able to summon a car to their home, and they will, in essence, be able to use it like public transport, and it will, in many respects, extend the use of a car in ways which are in some cases equivalent to private provision, in some cases equivalent to public provision. Now that obviously raises a whole series of issues about governance and who determines which of those public services should be provided and how they should be paid for, etc., etc. But the mere fact that one is opening up a wider array of potential providers does, I think, to my mind, introduce the possibility of essentially creating new innovative forms of public provision of services. In terms of Willem's question about use of providers as outside of the formal employment system, indeed, yes. And in that regard, one should, it comes back to my point about how much of this is essentially wealth diversion as against wealth creation. And so there is a great risk with a lot of these innovations that the wealth diversion element is essentially hidden or not incorporated in terms of looking at the overall effects, because it's not necessarily the case that it's going to appear in conventional ways of looking at, for example, national accounts. In terms of measuring the contribution of the financial system to wealth creation, that really came back to the point that I was making at the beginning, Cameron, that in essence that's an issue that people have increasingly looked at. Namely, the starting point for much of this area has been to pose the question, what is the relationship between financial development and economic development? And can one essentially evaluate the extent to which not only finance as a whole is contributing, but different parts of the financial system to the promotion of that growth and wealth enhancement? And finally, Ed, in relation to your question about payday loans, let me just really emphasize clearly, if there was any suggestion in what I was saying that I'm opposed to regulation, that is not the message that I was conveying at all. I was conveying a message of saying we have got the structure of our regulation, in many cases, seriously wrong. And indeed, the extent to which there is potential exploitation of those who are vulnerable, that is a particularly important area of where regulation is required. But on the other hand, if one looks at instances like the emergence of mobile money, what it is doing is providing protection to, providing protection to very exposed people who otherwise just get their money from money lenders who exploit at extremely prohibitive interest rates in terms of lending. So potentially, if one gets this right, it helps to address the sorts of problems that you're discussing in relation to payday loans, not exacerbating.
Good. Thank you very much. We're staring at the red light here.